is Eric Richards, and I am here to provide you an educational video that focuses on providing free, unbiased, and incredibly useful content for people who are new or seasoned investors. And a lot of the time, I've been asked, where do I put my money? How do I find the next GME? How do I find opportunities that are going to allow me to appreciate the value of my portfolio rapidly? And a lot of people right now, with their stimulus checks, they have a lot of time on their hand, their risk appetite is higher, and they want to start doing active trading as opposed to passively just putting their money in an ETF and letting it be for a couple of years. Now, there's nothing wrong with wanting to do that, but there's also a lot of risks that I believe need to be disclosed to investors. And I think that investors who are new to the game, this is probably the worst time to get in. Um, People who are semi-experienced and have been following the market, this is probably a good time to start. And people who have been investing for a long time, like me, I've been doing this for roughly 9 years. I do this basically full time now. I provide research for people. I don't do trading or investing for other people, so please don't ask me that. I will teach you how to trade yourself so that you can grow your money and you don't have to rely on other people. And let's get to it. So, valuations. There are probably countless ways to value a company, and let's just focus on two different assets. One is going to be financial stocks, and the other is going to be energy resources. And energy resources we're going to look at from the perspective of energy companies. You can look at energy from the perspective of just a commodity, as in oil, gas, biofuels, but it's useful to look at energy companies and then take a look at the commodity after to see how they can interact and how they affect each other. Now, there are some new factors that are influencing price action right now, and that means there's a lot of capital from the uh, new investors, which let's call dumb money for now because they haven't yet watched this video, and hedge funds like the ones that shorted GME. I also call them dumb money too because just because they're institutional does not mean they are good hedge funds. And there's a lot of ESG movements going on right now that are really pushing, especially towards the environmental side of things, and really prioritizing decarbonizing the energy sector. And even banks are having restrictions on their loans as to who they will lend money to. And the media and sponsored content are reinforcing that, as well as other market inefficiencies. And the spread of misinformation through the mainstream media has just reached epic proportions. It's almost discouraging if it wasn't for the fact that I know that's not where I want to go for my information. And if I want to find where good stocks are located, then I now have this one resource, which is ideally how to invest 101, that will provide a basic checklist of the things that you need to look at before making an investment. Now, I'm not saying you need to look at all these. I'm just going to go over some of the positive and negative sides of each valuation type and look at what companies are most effectively evaluated by what method. So, right now, less liquid stocks and micro caps are an opportunity that retail investors are really taking advantage of, especially because larger funds simply don't have the ability to enter less liquid positions and very small companies without fully acquiring them. And that is a method that Warren Buffett uses. But for companies that make uh, partial acquisitions, like ARC, for example, they're very limited in the size of the companies they can invest in. So retail investors don't have any limitation. We can invest in penny stocks if we want to, or stocks under $5, stocks with a market cap of less than a billion. We don't have any requirements that we have to follow. So that gives us a little bit more wiggle room and creativity in terms of how we can generate superior returns. Now, what do I define superior returns? Well, I use the metric alpha, and that's basically my returns minus the S&P 500 annualized every year, and the difference between the S&P 500 and my portfolio is the alpha, or basically the value I add to my portfolio. And right now, with China and Chinese people beginning their private investments in both US and Chinese companies, and with their economy soon to outsize the US, and all of the new regulations going on, there is going to be a lot of changes to market structure that will impact US investors as well as people around the world. And right now, the Hong Kong exchange is undergoing a bit of a transition as people are looking for growth and higher returns as opposed to more stable investments, and that means they're transitioning to the mainland, where these companies that are often overlooked by North American investors are actually providing better opportunities for people who want value and for people who want growth, because they're not yet exposed to the capital markets here in Canada and the US. And once they do get that exposure, then they have the benefit of both listings and a larger audience. And right now, state-owned enterprises are a major component of the emerging market and Asian growth. So that means that companies are owned by countries. And when evaluating a country, you have to change the way you look at things, and especially how it's going to impact the state-owned enterprises, such as Venezuela's oil company and National Oil Company, or Sinopec, or CNCP, which is the Chinese one. And right now, the US macro risk, which is usually an indicator of whether or not money should be placed in bonds and fixed income instruments or other asset classes like commodities, is basically at an all-time high, yet investors are willing to take on that risk because bond yields are at an all-time low. And MMT is a new monetary theory that basically is being fully embraced by the Biden and Yellen administration. And it says that printing money is not a problem as long as you have a prominent role in the international monetary system, as well as a large tax base and growing productivity. Now, the other risks we see right now are concentration risk, and this is probably the highest and most hidden risk that people are unable to avoid right now, and that's because ETFs used to provide a lot better diversification as a market cap weighted instrument. And right now, companies like Apple, Amazon, Microsoft, the FANGs, they're taking up such a large portion of the S&P 500, and even the NASDAQ is highly concentrated into a few large tech names, which causes concentration risk to be a lot higher than perceived. So just because you have a bunch of ETFs that are supposed to represent the economy, that doesn't mean that the economy itself is not highly concentrated in a few sectors, and a lot of the capital could very easily move out of these sectors into the more cyclical sectors that were hit hardest by the virus and that will obviously bounce back the hardest. The two deep value cyclical sectors that I like and that I think have the highest potential to give risk-adjusted returns to investors are definitely energy and banking stocks. Now,